So, imagine you are hunting for the next great AI SOC right now.
Yeah, which everyone is doing.
Right, everybody is. And you basically have two choices. You could pay, a 50 times revenue premium for some Silicon Valley software startup.
A startup that, let's be honest, might not even exist in 3 years.
Exactly, because the big tech platforms will just inevitably clone their product anyway. Or, and this is the crazy part, you could buy a somewhat boring legacy industrial company.
Right, a company making hospital sterilizers and voltage testers.
Yeah, and facility management software, a company that just quietly posted a massive 28% jump in earnings per share.
Which is just a wild number for that sector.
It really is. So today we are tearing into Fortive's Q2 2026 earnings to find out if this legacy manufacturer, trading under the ticker FTV, is actually the ultimate stealth AI play.
I love that framing, the stealth AI play.
Welcome to this deep dive into the source material. We are putting our Talk Tickers lenses on today.
Which means we are strictly data forward.
Yes, data forward. We are cutting through the corporate jargon, and we are delivering actionable insights for your portfolio.
And Fortive is really the perfect candidate for this approach because their earnings call reads like a masterclass in underlying business transformation.
It totally does. On the surface, you just see this industrial conglomerate.
Right. But when you parse the data from their CEO, Alumide, and CFO, Mark, you realize they are engineering this massive shift.
A shift toward high-margin recurring software.
Exactly. Software and proprietary hardware lock-in. So we're going to break down their headline financials, tear apart the specific operating segments driving this growth.
Especially the exploding demand from data centers, which is huge.
Oh, massive. Data centers and hospital operating rooms. Then we'll evaluate their forward guidance and ultimately give you a firm verdict on whether this is a structural compounder you should be holding.
So let's just get right into the raw data. Because frankly, the spread between their top line growth and their bottom line growth is where the entire narrative of this company lives.
It's the whole story, yeah.
Total reported revenue for the second quarter hit nearly $1.1 billion.
Which is up roughly 8% year over year.
Right. But management was really quick to point out that on a core basis, they grew 6.7%.
Now, obviously, we know core revenue strips out foreign exchange noise.
Yeah, currency fluctuations and, recent acquisitions, just to give us the true organic growth rate.
But I mean, a 6.7% core growth rate for a mature billion-dollar industrial manufacturer, that is still exceptionally hot.
It's extremely hot. But here's the question for you. How do they take 6.7% more sales and somehow synthesize that into an adjusted EBITDA of $323 million?
A 12% increase.
Right, a 12% jump in operating profit, and then ultimately deliver that staggering 28% jump in adjusted earnings per share to 74 cents.
Yeah, the math looks wild at first glance.
Because you don't just get a 4x multiplier on your EPS growth relative to your core revenue growth without pulling some serious operational levers. Is it just financial engineering?
Well, no, you don't get that multiplier by accident. And to understand it, you have to look at their margin expansion and their really aggressive capital allocation.
Okay, break that down for us.
Let's start with the operational side. Their adjusted EBITDA margin actually expanded by approximately 110 basis points, hitting 29.5%.
Wait, expanding by over a full percentage point in a single year?
Yes, exactly. And when a manufacturing business of this massive scale does that, it usually means one of two things.
Which are?
Either they have incredible pricing power and they're just raising prices way faster than inflation.
Sure, just passing the buck to the customer.
Right. Or they're executing structural cost takeouts at the factory floor level.
Getting leaner.
Exactly. And for Fortive, it's actually a combination of both. And it's driven heavily by this thing they call the Fortive Business System, or FBS.
Okay, let's hover on FBS for a second, because management touts this relentlessly on the call.
They do. They talk about it constantly.
And I think a lot of retail investors just dismiss it as corporate HR speak. Like, oh, cool, another corporate synergy acronym.
Yeah, just buzzwords on a slide deck.
Right. But there is a deep historical pedigree here that explains why their margins are expanding, while other industrial players are getting absolutely crushed by input costs right now.
Yes, and that history is crucial. Fortive spun out of Danaher back in 2016.
And Danaher is basically legendary on Wall Street.
Legendary. Mostly for the Danaher business system, which itself was derived directly from Toyota's Kaizen lean manufacturing principles.
So Fortive basically inherited that exact DNA.
Precisely. It is not an HR slogan at all. It is this ruthless, quantitative operating system applied to every single factory, sales desk, and supply chain node across the globe.
So what does that actually look like in practice?
Well, FBS dictates how they map value streams, how they eliminate waste on the production line, how they manage working capital.
Okay, so when macro headwinds hit, say, like inflation on rare earth metals or memory chips.
Which, by the way, analysts specifically asked about on this call.
Right, because everyone is feeling that inflation. So a normal company just absorbs that hit and their EBITDA margin shrinks.
Yep, they take it on the chin. But Fortive, using FBS, they deploy engineering teams to redesign a component to use less of that specific rare earth metal.
Oh, wow. They engineer the cost out of the product in real time.
Exactly. Or they lean out a completely different administrative process to offset the new material costs.
So this allows them to maintain a positive price-cost ratio.
Yes. They are keeping more of every single new dollar that comes in the door. And that is the foundational step in bridging that gap from 6.7% revenue growth up to 12% operating profit growth.
Okay, so the operational leverage gets us to the 12%.
Yeah.
The business is demonstrably more efficient.
Deadly efficient, yeah.
But we are still staring at a 28% EPS growth figure. That is a massive chasm.
It is a big leap.
And looking at the balance sheet, it is glaringly obvious that aggressive share repurchases are doing the heavy lifting for that final leg of the EPS jump.
Oh, absolutely. The buybacks are huge here.
They deployed roughly $200 million this quarter just to buy back stock. And since they initiated the strategy a year ago, they've spent nearly $2 billion.
Retiring 38 million shares.
Which is 11% of the entire company, just taken completely off the open market in 12 months.
It is a massive capitalization shift. I mean, truly massive. And this is where you really have to look at the quality of the buyback.
Because we've all seen companies take on terrible high-interest debt to buy back stock, right?
Exactly. Just to artificially prop up their EPS and, trigger executive bonuses.
But it's financial engineering at its absolute worst.
Yeah.
It eventually just destroys the balance sheet.
It does. But Fortive is funding this $2 billion buyback entirely through organic free cash flow.
Wow, not debt.
No debt. In this quarter alone, they generated $270 million in free cash flow. That brings their trailing 12-month total to over $1 billion.
And the metric that really stands out to me here, like this should be flashing neon for anyone evaluating the underlying health of this operation, is their cash conversion.
Oh, the conversion rate is stellar.
Their conversion of net income to free cash flow is running well over 100%.
Which is almost unheard of in heavy industrials.
Right. If your business requires you to constantly plow your profits back into heavy machinery, new foundries, expanding your physical footprint just to maintain your current market share,
you are never going to see over 100% cash conversion. You're just burning cash to stand still.
Exactly. So the fact that Fortive is achieving this tells me they are operating a highly capital-light model relative to their peers.
Spot on. Net income is essentially an accounting abstraction, right? It's heavily burdened by depreciation and amortization schedules.
Yeah, non-cash charges.
Right. But free cash flow, that is the actual oxygen the business breathes. When you are converting more than 100% of your net income into cash, it proves your growth doesn't require proportional capital expenditures.
It means you're not constantly buying expensive new factories just to grow.
Exactly. This is the hallmark of a business transitioning from heavy, clunky hardware to software, services, and high-margin consumables.
So when management takes that massive excess cash yield and cannibalizes 11% of their own float, it isn't some artificial sugar high.
Not at all.
It is a highly rational allocation of capital because they know their internal rate of return on retiring those shares is exceptionally strong, especially given their structural margin expansion.
Right. They are basically betting on themselves, and with cash they actually earn.
Okay, so the financial engine is pristine. They're extracting maximum operating leverage via FBS, and they're supercharging the per-share metrics with a cash-backed buyback program.
Yep, the spreadsheet looks beautiful.
But, you cannot squeeze blood from a stone. No amount of Kaizen manufacturing principles or share repurchases will save you if nobody wants to buy your actual products.
Very true. Sales cure all, as they say.
Right, $1 billion in free cash flow has to come from somewhere. What exactly is flying off the shelves?
Well, let's pivot to the operating segment, starting with the absolute powerhouse of the quarter, which is Intelligent Operating Solutions, or iOS.
Okay, iOS. What do they do?
The iOS segment grew 7.4% organically. That is really doing the heavy lifting for the company's overall 6.7% core growth.
Okay, so they are the growth engine right now.
They are. And within iOS, the undisputed crown jewel is Fluke.
I feel like anyone who works in trades knows Fluke.
Oh, absolutely. Fluke represents over 40% of Fortive's entire revenue base. If you are an electrical engineer, a network technician, a facility manager, Fluke is the gold standard for diagnostic testing tools.
It's the yellow multimeter everyone has in their toolbox.
Exactly, the iconic yellow tools. And right now, Fluke is experiencing a demand environment that is frankly hard to wrap your head around.
What did management say about it?
They noted that order volume is actively outpacing revenue growth. Their book-to-bill ratio is over 1.0.
Meaning they were taking in new orders faster than their factories can physically box them up and ship them out.
Yes, they literally can't make them fast enough.
And CEO Olamide was very explicit about what is driving this demand imbalance. It all comes back to the global race to build AI infrastructure.
It always comes back to AI these days, right?
It really does. He specifically highlighted a product called the CertiFiber Max, noting it is running dramatically above plan.
Yeah, the CertiFiber Max.
Now, on the surface, a fiber optic tester sounds like a niche, commoditized piece of hardware. Why is the entire data center industry suddenly treating this specific Fluke device like it's water in a desert?
Well, it comes down to the physical realities of training large language models. We always talk about AI in the abstract, like algorithms just floating in the cloud.
Yeah, magic internet math.
Right. But physically, the quote-unquote cloud is millions of GPUs housed in massive data centers. And these GPUs have to talk to each other to process the training parameters.
And they don't do that over Wi-Fi.
No, absolutely not. They are connected by incredibly complex, high-density fiber optic networks moving from 400G to 800G speeds.
Which is blisteringly fast.
Unbelievably fast.
Yeah.
And at these data transfer rates, the tolerance for error is practically zero.
So what happens if there's an error?
Well, a microscopic speck of dust on a fiber end face, a slight micro bend in the cable, or an imperfect splice can cause insertion loss or signal reflection.
And if a packet of data drops during a massive AI training run?
The latency introduced can cost these tech giants millions of dollars in compute time, literally millions.
Right, so you can't just run miles of fiber, plug it into the servers, and cross your fingers.
Definitely not. You have to certify the integrity of the physical layer before you ever flip the switch.
And that is where Fluke comes in.
Precisely. Every single fiber strand has to be tested and certified to strict industry standards.
And doing that manually must be a nightmare.
Historically, testing high-density cables, some of which have 12 to 32 individual fibers in a single tiny connector, was an incredibly tedious, labor-intensive process.
So what does the CertiFiber Max actually do?
The CertiFiber Max automates this. It can test 2 fibers across 2 wavelengths in something like 3 seconds.
3 seconds? That's insane.
It is. When you are a hyperscaler like Microsoft or Google or a major contractor building these massive facilities, speed to deployment is your ultimate bottleneck.
Because every day the data center isn't online, you're losing money.
Exactly. So if a Fluke tool cuts your network certification time in half, you do not care what the tool costs.
You just buy it.
You buy one for every single technician on the site. And that is why the demand is skyrocketing.
This is exactly why I mentioned the idea of Fortive being the ultimate stealth AI play.
It makes total sense now, right?
It does. The AI software landscape is a bloodbath of valuation bubbles and unproven business models. But if you want derivative exposure to the hundreds of billions of dollars in capital expenditure that big tech is pouring into physical infrastructure.
You don't necessarily want to buy the BPU designers who are priced to perfection.
Exactly. You want to buy the company selling the immune system for the data center.
That is the perfect way to frame it, the immune system.
They aren't building the AI brain. They are selling the vital signs monitors that ensure the brain doesn't overheat, drop signals, and die.
And the strategic beauty of this position is the pull-through effect.
Oh, like a Trojan horse?
Yes. A contractor comes to Fluke desperately needing a fleet of CertiFiber Max units to hit a deadline for a new AI facility.
Because they can't finish the job without it.
Right. But A data center isn't just fiber optics. It requires massive, uninterrupted power supplies, heavy-duty HVAC systems, and battery backups.
So while Fluke has the contractor on the phone for the fiber tester,
Because Fluke has their attention, they end up outfitting the technicians with Fluke's entire suite of legacy tools.
so they're selling the power quality analyzers, thermal imagers for the switchgear, battery testing equipment.
Exactly. The new high-demand product acts as a Trojan horse to drive broad-based volume across their older product lines.
Which perfectly explains why management noted broad-based strength in North America, Asia Pacific, and Latin America for the iOS segment.
It completely offset the macroeconomic sluggishness we are all seeing out of Europe right now.
Because the AI infrastructure build-out is totally global, and it is dragging the rest of Fluke's portfolio up of it.
It really is. But Fluke isn't the only engine here. We have to look at their second major segment, too.
Right. Advanced Healthcare Solutions, or AHS.
Yes. AHS grew 5.3% organically. Now, not quite the blistering 7.4% of iOS, but 5.3% in the current healthcare environment is highly notable.
What's the main driver there?
The core driver of AHS is advanced sterilization products, or ASP. They basically dominate the market for low-temperature sterilization of surgical instruments.
The dynamic with ASP over the last year has been really choppy, though, hasn't it?
Very choppy. Hospital systems have been under immense budget pressure.
Labor costs skyrocketed, supply chain costs went up, and as a result, hospital administrators essentially froze their capital expenditure budgets.
They did. They delayed buying new, expensive sterilization machines. They just relied on their aging fleets and bought the chemical consumables to keep them running.
But on this call, management confirmed a critical inflection point. ASP's capital equipment sales have officially returned to growth.
And hospital CapEx is always cyclical. You can delay equipment upgrades for a year or two, but eventually the maintenance costs on the old machines become prohibitive.
Or they just break down.
Right, or they simply can't handle the volume. And the operating room is the primary profit center for any hospital.
So if your sterilization throughput creates a bottleneck that limits the number of surgeries you can perform in a day.
The hospital bleeds money, the dam finally broke this quarter, and those deferred equipment orders are turning into revenue again.
But there's a massive structural catalyst buried in this earnings call that guarantees this equipment refresh cycle is going to have long-term legs, isn't there?
Oh, absolutely. You are talking about the FDA clearance.
Yes. Alamide specifically carved out time to highlight that ASP received FDA clearance for a 50-pound expanded load capacity for their steroid machines.
Which is huge.
Now, to our listeners, if you aren't familiar with surgical hardware, 50-pound load capacity probably sounds incredibly mundane.
Like a heavy-duty washing machine or something?
Exactly. But this is actually a massive unlock for their total addressable market regarding robotic surgery, isn't it?
It is a total game changer. Think about traditional laparoscopic surgery. The instruments are relatively light, simple metal tools.
Right, easy to clean.
Now think about the massive boom in robotic-assisted surgery, like the Da Vinci systems.
Those are huge.
The robotic arms and the end effectors attached to them are highly complex. They are heavy, they contain internal cables, pulleys, and really sensitive microelectronics.
So you can't just toss those into a normal high-heat autoclave.
You absolutely cannot put these robotic instruments into a traditional steam autoclave. The high heat and moisture will instantly destroy the electronics and degrade the precision components.
They need a special process.
They strictly require low-temperature sterilization, which is exactly what ASP's hydrogen peroxide gas plasma steroid machines do.
Wait, standard surgical instruments don't weigh anywhere near 50 pounds?
Mm-hmm.
Are they adapting the load capacity of these steroid machines specifically to handle the sheer bulk and weight of the robotic arms?
Yes, that is exactly what they're doing.
So they aren't just selling a standard hospital upgrade. They are effectively taxing the entire robotic surgery boom.
That's a great way to put it. Before this FDA clearance, a hospital might only be able to process a very limited number of heavy robotic instruments per sterilization cycle.
Because the machine wasn't validated for that much mass.
Exactly. And that creates a massive bottleneck. If a surgeon has to wait for sterilized robotic arms, the OR sits empty.
And the hospital loses thousands of dollars an hour.
Precisely. So by securing FDA clearance for a 50-pound load, ASP allows hospitals to safely pack these machines with heavy robotic equipment.
Drastically increasing the throughput of the sterilization department.
Right. If a hospital is spending millions of dollars on a new robotic surgery wing, they are functionally required to upgrade their sterilization fleet to ASP's higher capacity machines to support it.
Again, it is a brilliant derivative play. As a retail investor, you don't have to try and pick the winner among the various medical device companies developing surgical robots.
No, you just invest in the company that makes the mandatory specialized washing machine that every single one of those robots relies on to function safely.
So between Fluke riding the data center build-out and ASP riding the robotic surgery wave, the volume demand is clearly there.
The top line is incredibly strong.
But looking at the financials for these segments, there's a glaring metric that usually sends Wall Street into a panic, and yet the stock didn't crater.
You're talking about the gross margin contraction.
Yes. Mark, the CFO, stated the company-wide adjusted gross margin fell by 100 basis points to roughly 63%.
And in the AHS healthcare segment, it contracted by 110 basis points.
Now, as an investor, when you see a company's gross margins contracting by over a full percent, the immediate assumption is that the business is bleeding.
Oh yeah, usually it's a huge red flag.
You assume they are facing runaway inflation on raw materials that they can't pass on to the customer. Or worse, they are losing market share and are forced to heavily discount their products just to move inventory.
But management vehemently denied both of those scenarios.
Right. They blame the margin squeeze entirely on product mix. Why is the market giving them a pass on this? What exactly is happening in their product mix that makes a shrinking gross margin acceptable?
Well, Wall Street gave them a pass because institutional analysts understand that a declining gross margin percentage is not always indicative of pricing weakness.
Okay, so what is it then?
It is often just an artifact of highly successful sales in specific, strategically vital categories.
Meaning they sold a ton of something that just naturally has a lower margin.
Exactly. In Fortive's case, they experienced explosive volume growth in two specific areas that inherently carry a lower gross margin than their corporate average.
What were they?
Well, in the iOS segment, it was enterprise software deployments through their Service Channel brand.
Okay, Service Channel. What do they do?
Service Channel provides multi-site facility management software. Think of massive retail chains using the software to manage HVAC repairs across thousands of stores.
Right, so when you sign a massive new enterprise software client, there are heavy upfront implementation and onboarding costs.
Yes, and those costs hit the gross margin immediately, even though the long-term recurring revenue will be highly profitable.
So the software margins look bad on day one, but great in year 3.
Exactly. And in the healthcare segment, the margin drag was actually the return of the capital equipment cycle we just talked about.
Oh, because selling a massive metal sterilization machine has a lower gross margin profile than selling the proprietary chemical cassettes that the machine consumes.
Precisely. The razor and blades model.
Yeah.
Because hospitals finally started buying the heavy capital equipment again this quarter, a larger percentage of ASP's total revenue came from these lower margin machines.
So the overall gross margin percentage gets mathematically weighed down by this mix.
Right. They didn't slash the price of the machines, and the cost to build them didn't skyrocket. They just sold a ton of them.
So it's a structural trade-off. You take a slight hit on the blended gross margin today to vastly expand your installed base.
Yes, because every new steroid machine they place in a hospital guarantees a decade of highly profitable, recurring, consumable revenue.
Hospitals forced to buy ASP-specific sterilization chemicals.
Exactly. And every new Service Channel deployment guarantees years of sticky sauce revenue. So the gross margin contraction isn't a sign of weakness, it's a leading indicator of future recurring cash flow.
That makes total sense. And this goes back to our earlier discussion about operational leverage.
It does, because even with the gross margin percentage dipping slightly, their total EBITDA margin still expanded by 110 basis points.
Right, so they are controlling their fixed operating expenses so effectively through the Fortive business system that the sheer volume of these new sales just covers the overhead.
Yes, allowing more pure profit to flow to the bottom line. It is a highly managed, intentional strategy.
And part of that intentional strategy is continually optimizing that product mix through aggressive targeted M&A.
Right. Their acquisition strategy is very specific.
Because this isn't the company doing massive transformational bet the company acquisitions.
No, they execute what they call bolt-on acquisitions.
The one they highlighted this quarter was taking a majority stake in a company called UVsmart. How does UVsmart fit into this broader thesis of locking in the hospital ecosystem?
Well, UVsmart specializes in UVC high-level disinfection technology.
Okay, UVC light.
Right. Standard chemical sterilization is great for surgical steel and complex robotic arms. But hospitals also use thousands of smaller, highly sensitive electronic devices.
Like iPads.
iPads, specialized monitors, certain diagnostic scopes, things that can't be subjected to gas plasma. UVC light provides rapid medical-grade disinfection for these specific electronics.
So by acquiring UVsmart, Fortive bolts this technology directly onto ASP's global distribution platform.
Exactly. Now, an ASP sales rep walks into a hospital system and doesn't just pitch a solution for the operating room.
They pitch a comprehensive, facility-wide infection prevention portfolio.
Right. They capture a larger share of the hospital's total procurement wallet. It makes the ASP ecosystem significantly stickier and much harder for a competitor to displace.
That ecosystem lock-in is basically the holy grail for industrial companies. And it seems like Fortive is using artificial intelligence to deepen that moat even further.
Yes, and they are doing it in a very smart way.
Because we see so many industrial legacy brands just slapping the letters AI onto their press releases to try and catch a bid from retail investors.
Oh, totally. The AI washing is out of control.
But Olamide was adamant that Fortive has operated an AI center of excellence for 7 years.
7 years. Long before ChatGPT was a thing.
Right. They aren't pivoting to AI. They are embedding it into their core offerings. They mentioned Gordian's Flash AI for construction cost estimating and Fluke's EMEA AI for predictive maintenance anomaly detection.
And this is a critical distinction for investors trying to evaluate AI exposure. If you invest in a pure-play AI software startup, their only competitive advantage is their algorithm.
Which is dangerous, because algorithms are rapidly commoditizing.
Exactly. The real value is the proprietary data feeding the algorithm. And Fortive has millions of hardware devices already physically installed in 100,000 facilities around the globe.
So they're collecting exabytes of proprietary data on electrical currents, acoustic vibrations in motors, temperature fluctuations in data centers.
Right. So when Fluke rolls out eMaint AI, they aren't trying to sell a generic predictive maintenance software to a skeptical IT department.
The AI is trained on Fluke's own proprietary data set.
Yes, and it's communicating directly with Fluke hardware that the customer already trusts.
So it tells a factory manager, based on the acoustic signature our sensor is ticking up, this specific conveyor belt motor has a 90% chance of failing in the next 48 hours.
Exactly. It transitions Fortive from being a company that sells you a tool to diagnose a problem to a partner that prevents the problem from occurring in the first place.
This type of embedded, hardware-backed AI creates a two-sided network effect of physical switching costs and proprietary data advantages that a standalone software company simply cannot replicate.
They just can't. The moat is too deep.
So the operational execution is stellar. They have the right products with the right macro trends. They are strategically sacrificing a bit of gross margin to build long-term recurring revenue. And they are deploying AI to lock in their massive installed base.
It's a great setup.
But the stock market is inherently forward-looking. Institutional investors do not care what you did in Q2. They care if you can sustain it in Q3 and Q4.
Always looking ahead.
Let's evaluate their forward posture, because management guidance is where earnings calls usually get incredibly tense.
Yeah, the guidance provided by Olamide and Mark was, quite frankly, a display of immense swagger disguised as conservative accounting.
Swagger? How so?
Well, the headline here is that management raised the full year 2026 adjusted EPS guidance to a range of $2.95 to $3.05.
That's a little bump.
But more importantly, they raised their full year reported revenue expectation to approximately 4%. That's up significantly from their previous internal estimate of 2 to 3%.
Okay, for a company doing nearly $6 billion in annual revenue, bumping up your full year growth expectations by a full 100 to 200 basis points halfway through the calendar year is a massive signal.
It is a huge vote of confidence.
It tells you that the order momentum they are seeing in Fluke and ASP isn't a one-quarter blip. It is a structural backlog that gives them complete visibility into the back half of the year.
Exactly. They know the money is coming.
But as with all CFOs, Mark spent a significant amount of time caveats and managing expectations around Q4 specifically.
Yes, the calendar quirks.
He went out of his way to warn analysts about quote-unquote calendar quirks, noting that Q4 of this year has 4 fewer selling days than Q4 of the prior year.
Right.
He quantified this as a $15 to $20 million reported revenue headwind and a 150 basis point drag on core growth for that specific quarter.
Which sounds incredibly pedantic.
It really does. To the average retail investor, warning Wall Street about the calendar sounds absurd. Does a multi-billion-dollar industrial giant really need to handhold sophisticated analysts through the fact that December has weekends and holidays?
Yes, they absolutely do. Because institutional financial models are relentlessly rigid.
How so?
Analysts build their spreadsheets by extrapolating historical run rates. If Q4 of last year had 64 working days where factories were shipping products, invoices were clearing, and revenue was being recognized.
The analyst just assumes a similar baseline for this year, applies their estimated growth rate, and publishes a revenue target.
Exactly. But if the calendar shifts, and this year's Q4 only has 60 working days, you have literally lost 6% of the available time to generate cash.
So if Mark doesn't explicitly spell this out in Q2, what happens in January when they report Q4?
If he doesn't spoon-feed this to the street right now, the analysts will publish unadjusted, overly optimistic models.
And then Fortive misses those targets.
Yes. In January, Fortive will technically miss those revenue estimates by $20 million.
Even though the business is fine.
Right. But the algorithms that scan the news wires will see a top-line miss, trigger programmatic sell orders, and the stock could easily gap down 5 or 10% at the open.
Just because of the calendar.
Just because of a spreadsheet error regarding the Gregorian calendar. By quantifying the exact dollar impact of those 4 missing days 6 months in advance, Mark is forcing the analysts to bake the headwind into their models today.
Protecting this stock from an algorithm-driven panic later. That makes a lot of sense.
It's just smart CFO work.
But wait, if they are highlighting a $20 million headwind for Q4, are they just sandbagging?
What do you mean?
Like, is management setting a remarkably low bar for the end of the year so that when January rolls around, they can easily jump over it, declare a massive beat, and collect their executive bonuses?
Ah, the classic under-promise, over-deliver.
Right. Corporate sandbagging is a time-honored tradition on Wall Street.
It is, but you have to look at the holistic guidance to separate sandbagging from responsible expectation management.
Okay, so why isn't this sandbagging?
If Fortive was truly sandbagging, they would have used the Q4 calendar headwind as an excuse to keep their full-year guidance flat or even lower it. They would have played the victim to the calendar.
But they didn't.
No, they didn't. They actively raised the full-year revenue and EPS finish line, despite pointing out the significant hurdle in the final lap.
Right, they bumped it up to 4%.
Exactly. They are effectively telling the market, yes, Q4 is structurally annoying, but the underlying organic demand is so ferocious right now that we are going to beat our total annual targets regardless.
That is confidence wrapped in radical transparency.
It really is.
And speaking of transparency, there was another accounting decision Mark detailed that I found fascinating regarding a government windfall.
Oh, the tariff refunds, yeah.
He noted that Fortive received a $4.5 million tariff refund this quarter, and they expect another $20 to $25 million in tariff refunds to hit their accounts over the coming quarters.
Which is a nice chunk of change.
It is actual hard cash being deposited into their bank accounts. Yet management explicitly stated they're stripping this cash out of their adjusted earnings metrics.
Yep, completely backing it out.
Why on earth would a CEO take $25 million of pure profit and voluntarily hide it from the headline EPS number that Wall Street focuses on?
Because institutional trust is far more valuable than a one-time EPS sugar high.
Expand on that.
Well, tariffs, particularly the Section 301 tariffs on industrial components, have been a volatile reality for manufacturers. When a company successfully appeals a classification and secures a massive retroactive refund from the government, it is a tremendous cash windfall.
Right. It's a great day for the accounting department.
But it has absolutely zero predictive value regarding how well Fortive is manufacturing and selling diagnostic tools or hospital sterilizers. It is entirely non-operational.
So if they included it in their adjusted EPS, they would look like heroes this quarter.
They would. But next year, when the government isn't handing them $25 million checks?
Their year-over-year EPS comparisons would completely collapse.
Exactly. They would be setting themselves up for a massive perceived earnings miss down the road, even if the core business was executing flawlessly.
Which would crush the stock.
The volatility would be catastrophic for their valuation multiple. Quality industrial compounders trade at premium multiples precisely because their earnings are predictable.
So by voluntarily excising the tariff refund from the adjusted metrics, Management is reinforcing the integrity of their numbers.
They are telling investors, judge us strictly on our operational execution. No accounting tricks, no one-time windfalls.
It builds immense institutional credibility.
It does. And realistically, the cash doesn't disappear. It just sits on the balance sheet, ready to be deployed into more share repurchases or more bolt-on M&A.
Which will organically drive shareholder value anyway. The forward outlook is bulletproof. They've raised the bar, they're transparently managing the calendar anomalies, and they are maintaining strict accounting discipline.
It was a very clean call.
Crucially, they also reiterated their expectation for 50 to 100 basis points of annual EBITDA margin expansion across 2026 and 2027.
Showing that the margin gains are permanent.
Right. It proves that the 110 basis point expansion we saw this quarter wasn't a fluke. It is the structural reality of the Fortive business system optimizing this newly software-heavy product mix.
Absolutely.
So we've dissected the financials, explored the critical end markets in data centers and hospitals, and vetted the management guidance. It is time to synthesize this data. Let's move to the bottom line.
All right, let's do it.
Based on the strict criteria of the talk tickers format, evaluating the data, the strategic positioning, and the capital allocation, the verdict on Fortive, ticker symbol FTV, is aggressively bullish.
Highly bullish. The market often misprices legacy industrial companies undergoing digital transformations, and Fortive is executing that transition flawlessly.
For the retail investor sitting at home, what are the primary actionable takeaways you need to understand if you are holding this stock or considering initiating a position?
Well, the first actionable takeaway is recognizing the downside protection built into this stock.
You mean the buybacks?
Yes. When you invest in a business that converts over 100% of its net income to free cash flow, and management is actively utilizing that cash to retire 11% of the outstanding shares, you are investing alongside a relentless programmatic buyer.
The company itself is constantly buying the stock.
Exactly. This aggressive share repurchase program acts as a concrete floor for the stock price during broader macroeconomic drawdowns.
Okay, that's takeaway one. What's the second?
The second actionable takeaway is the inflation resistance embedded in their culture. We touched on the Fortive business system, but it really cannot be overstated.
Right, the FPS.
If we enter another cycle of supply chain shocks or commodity inflation, you do not want to hold a manufacturer that simply hopes to pass costs onto the consumer.
Because consumers will eventually push back.
Right. You want a company that utilizes a formalized Kaizen process to strip micro inefficiencies out of the production line daily.
That is how Fortive maintains positive price-cost ratios and expands margins while their competitors' margins compress.
Yes. It makes the asset incredibly durable across economic cycles.
And the third takeaway?
The final takeaway is understanding their risk-adjusted growth profile. Every investor wants exposure to AI and automation.
But pure-play tech stocks are hyper-volatile, capital-intensive, and priced for absolute perfection.
Exactly. Fortive offers a much lower risk alternative. They are shifting away from episodic hardware sales toward recurring customer value.
Lifetime software licenses, continuous calibration services, and high-margin chemical consumables.
Right. This smooths out their revenue stream, making it highly predictable. And at the same time, their strategic bolt-on M&A insulates them from the massive integration risks of large-scale tech buyouts.
So what does this all mean? It really is the ultimate, quote-unquote, eat your vegetables stock that ends up performing like a growth asset.
It really is.
I mean, you aren't going to impress anyone at a dinner party by bragging about your position in a company that makes hydrogen peroxide sterilizers and electrical multimeters.
It's definitely not a sexy cocktail party stock.
No. But under the hood of that boring exterior is a cash printing machine delivering tech-like 28% EPS growth.
And this raises an important question, I think. It forces a total reevaluation of how we categorize growth stocks in general.
How so?
The assumption over the last decade has been that software eats the world and hardware is just a depreciating commodity.
Right. Everyone wanted SaaS businesses.
But as software development becomes increasingly democratized by AI, that paradigm might actually flip.
That is the perfect thought to leave our listeners with today.
Let's hear it.
As AI becomes ubiquitous, as every company basically gains access to roughly the same generative algorithms, the software brain itself ceases to be a competitive moat.
Exactly. Everyone has the brain.
Right. So the real advantage shifts to the companies that control the physical body. The winners of the next decade might not be the Silicon Valley startups writing new code.
Because AI can write the code.
Yes, they might be the legacy industrial stalwarts like Fortive, who already have their proprietary hardware entrenched in millions of critical facilities worldwide.
And they are simply using AI to make that physical footprint smarter, stickier, and virtually impossible to rip out. It is a profound shift in the investment landscape, and Fortive's Q2 results are a leading indicator that this transition is already well underway.
Keep digging into the numbers, look past the corporate jargon, and always question the market consensus. We will see you on the next deep dives into the source material.